Whatever you do, don't look away from Tokyo right now. I know. You're watching the S&P 500. You're watching the Federal Reserve. You're wondering if your Christmas bonus is going to survive the new year. But while Wall Street is distracted by holiday parties, something critical just broke in the global financial plumbing. It's December 22, 2025. Late Friday, while the Western world was sleeping, the Bank of Japan did the unthinkable. For the first time in 30 years since the era of dial-up internet and blocky cell phones, Japan's benchmark interest rate has smashed through the ceiling, hitting 0.75%. Now, 0.75% sounds like a joke to us in the US, right? We've been dealing with rates north of 4% and 5% for years. But in Japan, where money has been free, literally free, for decades, this is a seismic shift. This is an earthquake. But here is the mystery, here is the thing that should keep you up at night. Normally, when a central bank raises rates, their currency gets stronger. It's economics 101. You pay people more to hold your money, the money goes up. Simple. But on Friday? The Bank of Japan hiked rates, and the yen collapsed. It tanked against the dollar, sliding past 157. The market looked at Governor Kazuo Ueda, took the rate hike, and effectively spit in his face. Why? Because the global markets smell fear. They smell a central bank that is trapped between a dying currency and an economy addicted to cheap debt. And if you think this is just a Japanese problem, think again. Japan is the largest holder of US government debt. They are the anchor of the global financial system. If that anchor drags, it pulls down everything, your tech stocks, your mortgage rates, and the value of the dollars in your wallet. Today, we are peeling back the layers of this disaster. We're going to explain why the Widowmaker trade is back, why the yen is crashing despite higher rates, and why this specific divergence between the US and Japan in late 2025 is the single biggest risk to your portfolio heading into 2026. Buckle up. Let's set the scene. It is 2025. The global economic landscape has shifted dramatically from where we were just a few years ago. Here in the United States, we are finally seeing the other side of the inflation mountain. The Federal Reserve, under intense pressure, has cut rates 3 times this year alone. The American economy is cooling. Borrowing costs are coming down. We are in a loosening cycle. But cross the Pacific, and you enter the twilight zone. Japan is moving in the exact opposite direction. They are the only major central bank in the world raising rates this year. Everyone else is cutting, Japan is tightening. So, what happened on Friday? Governor Kazuo Ueda and his policy board voted unanimously to hike the benchmark rate by a quarter point to 0.75%. This wasn't a rogue decision, it was unanimous. They cited solid wage growth and receding risks from US tariffs. We'll get to the Trump tariffs in a minute as the green light. For context, for the better part of 2 decades, this rate was zero. Or negative. Imagine a bank charging you to keep your money there. That was Japan. Now, they are marching toward 1% and beyond. But here is the twist that has Wall Street scratching its head. When the news hit the wires, the yen didn't rally. It cratered. It weakened past 157.10 against the dollar. Traders started selling the yen aggressively. Why? Because of the messaging. In the high-stakes poker game of global finance, Governor Ueda blinked. The market was hungry, starving, for a hawkish signal. They wanted Ueda to come out swinging, promising rapid-fire hikes to save the currency. Instead, Ueda gave a press conference that sounded hesitant. He said the rate path depends on the state of the economy. He admitted he doesn't even know where the neutral rate is, that magical number where the economy is perfectly balanced. Market participants, like Masamichi Adachi at UBS, basically said, "Is that it?" The market interpreted Ueda's caution as weakness. They bet that Japan doesn't have the stomach to go higher, faster. So, you have this bizarre situation, Japan hikes rates to a 30-year high, and the currency acts like they just cut them. This confirms one terrifying fact: the Bank of Japan has lost control of the narrative. They are chasing inflation from behind, and the market knows it. Inflation in Japan has been above their 2% target for 44 straight months. That's almost 4 years of prices grinding higher, eating away at the savings of the Japanese elderly. And this brings us to the neutral rate problem. The BOJ estimates the neutral rate is between 1% and 2.5%. They are currently at 0.75%. They are miles behind the curve. They are driving a car at 100 miles per hour while looking in the rearview mirror, hoping they don't crash. Now, I need you to focus. This is the part where we connect Tokyo to your brokerage account in Chicago or London. To understand why a weak yen and a slow hiking BOJ matters to you, we have to talk about the carry trade. For the last 20 years, the Japanese yen has been the funding currency of the world. Because interest rates were zero, hedge funds, banks, and savvy investors would borrow billions of yen for free. They would take that borrowed yen, convert it into US dollars, and buy assets that actually pay a yield like US Treasury bonds, or more likely, shares of Nvidia, Apple, and Tesla. Think about it. If I can borrow money at 0% and invest it at 5% or 10%, that's free money. It's an infinite money glitch. Trillions of dollars of global liquidity are built on this foundation. Japan is the ATM of the world. But this trade relies on one thing, the yen staying weak and interest rates staying low. If the Bank of Japan raises rates, suddenly that free money costs money. If the yen strengthens, you have to pay back that loan with more expensive currency. The trade blows up. This is why Friday's reaction was so confusing and so dangerous. The market should have been terrified of the rate hike unwinding this trade. But because Ueda sounded weak, traders doubled down. They are betting that the free money spigot is still open. This creates a massive bubble risk. If the yen keeps weakening, hitting 160 or 165 against the dollar, it forces the Bank of Japan into a corner. They might be forced to shock the market with a massive hike later just to stop the bleeding. If that happens, if they are forced to slam on the brakes in 2026, we are looking at a margin call for the entire global financial system. All those investors who borrowed yen to buy US stocks will have to sell those stocks to pay back their yen loans. That means a massive sell-off in the S&P 500. We saw a preview of this in July 2024. Do you remember? The BOJ hiked unexpectedly, the yen spiked, and global markets melted down for a few days. It was carnage. Now, fast forward to today, December 2025. The BOJ is hiking again, but they are trying to whisper it so they don't spook the markets. They are terrified of popping the bubble they helped create. Governor Ueda is walking a tightrope over a pit of alligators. On one side, if he hikes too fast, he crashes the US and Japanese stock markets. On the other side, if he hikes too slow, the yen becomes toilet paper, and inflation destroys the Japanese middle class. This isn't just about math, it's about politics. And the political situation in Japan right now is volatile. Enter Sanai Takaichi. She became prime minister back in October 2025. If you don't know her, think of her as a heavy proponent of Abenomics on steroids. She loves spending. She loves monetary easing. She is historically a dove, someone who wants low rates to stimulate growth. When she took office, everyone thought, game over. The BOJ will never be allowed to hike rates. But here we are. Why did she let this happen? Because inflation is a political killer. Japanese voters are angry. For decades, prices in Japan didn't move. A can of coffee cost 100 yen in 1995 and 100 yen in 2020. But now? That can of coffee is 130 or 140 yen. Energy prices are up. Food prices are up. Real wages are struggling to keep up. The weak yen is the culprit. Japan imports almost all its energy and food. When the yen is weak against the dollar, everything Japan buys gets more expensive. So, Prime Minister Takaichi is in a bind. She wants low rates to help businesses, but she needs a stronger yen to stop voters from revolting over the cost of living. Her party, the LDP, already took massive hits in the last two elections. She is fighting for survival. This is why she didn't block Friday's hike. As analysts noted, 98% of BOJ watchers believe the fall in the yen forced her hand. But here is the conflict, the BOJ needs to hike to save the yen, but the government wants to spend money to boost the economy. Fiscal expansion plus monetary tightening is a recipe for volatility. It's like pressing the gas and the brake at the same time. And let's look at the US angle, the Trump factor. The report mentioned that risks from US tariffs are receding. This is fascinating. It suggests that by December 2025, the initial panic over President Trump's trade war has settled. Japan seems to have carved out an exemption or found a way to navigate the America First landscape without getting crushed. However, if the yen stays this weak, Japanese cars and electronics become incredibly cheap for American buyers. That widens the US trade deficit with Japan. How long until President Trump looks at the yen at 160 and says, Japan is manipulating their currency to undercut American manufacturers? If Trump decides to target Japan for currency manipulation, we are looking at a trade war that will make 2018 look like a playground fight. This adds another layer of risk to Japanese automakers like Toyota and Honda, which are staples in many of your portfolios. To understand the severity of this, we have to look back. Japan is traumatized by the 1990s. The asset bubble burst, the stock market crashed, and they spent 30 years in deflation. Prices went down. For a generation of Japanese policymakers, inflation was the goal. They prayed for it. They printed money to get it. Now, like the genie released from the bottle, they have it. But it's the wrong kind of inflation. It's cost-push inflation, imported inflation from a weak currency, not demand-pull inflation from a booming economy. The BOJ is forecasting hikes once every 6 months. Maybe 2 hikes in 2026, reaching 1.5% by 2027. Is that enough? Let's do the math. If inflation is running at 3% and your interest rate is 0.75%, your real interest rate is negative 2.25%. That is still incredibly stimulative. You are effectively paying people to borrow money. This suggests that the BOJ is way behind the curve. They aren't fighting inflation, they are waving at it as it goes by. Compare this to the US. Our inflation is hovering around 2 to 3%, and our rates are still significantly higher. We have positive real rates. Japan has deep negative real rates. This divergence means money will naturally flow out of Japan and into the US to chase higher yields. That flow weakens the yen further. It is a vicious cycle. Weak yen - higher inflation - negative real rates - capital flight - weaker yen. Unless the BOJ shocks the market with a massive hike, say, jumping to 1.5% overnight, they might not be able to break this cycle. But a massive hike crashes the economy. They are checkmated. So, where do we go from here? Let's look at the best case and worst case scenarios for 2026. The best case, the Federal Reserve cuts rates aggressively in 2026. This weakens the US dollar. As the dollar falls, the yen naturally strengthens back to 130 or 140. This takes the pressure off the BOJ. They can continue their slow, gentle hikes once every 6 months without breaking anything. The global carry trade unwinds slowly and orderly. Your stocks stay safe. The worst case, US inflation spikes again, forcing the Fed to stop cutting. The dollar rips higher. The yen crashes to 170. The Bank of Japan panics. Prime Minister Takaichi's government is on the verge of collapse due to anger over prices. The BOJ is forced to emergency hike rates by 50 or 75 basis points. This triggers the margin call from hell. Hedge funds dump US treasuries and US tech stocks to cover their yen loans. US yields spike. Mortgage rates in the US jump back up to 8%. The stock market takes a 20% correction. Which scenario is more likely? Right now, the market is betting on the soft landing. But the market is notoriously bad at predicting currency crises. The fact that Japanese government bond yields just hit 2%, the highest since 1999, tells me that the bond market is getting nervous. The bond vigilantes are waking up in Tokyo. When bond yields rise in Japan, Japanese institutional investors who hold trillions in US and European bonds start bringing that money home. Why take the currency risk in the US for a 4% yield when you can get a safe 2% at home in yen? This repatriation of capital is the silent killer of global liquidity. As Japanese money leaves Western markets to go back to Tokyo, it leaves a hole in demand for our debt. Who fills that hole? The Fed? Not if they are worried about inflation. So, what should you do? If you are an investor, you need to have a hedge. The days of set it and forget it in the S&P 500 might be numbered if this Japanese unwinding accelerates. Keep a very close eye on the US dollar to Japanese yen exchange rate. 160 is the danger zone. If we cross that, expect intervention, volatility, and potential panic selling in US equities. Also, watch the 10-year JGB yield. If that shoots above 2.5%, the repatriation flow will turn into a flood. Friday's decision was a warning shot. The Bank of Japan is trying to normalize policy after 30 years of addiction to cheap money. But withdrawal symptoms are painful, and the patient, the Japanese economy, is unstable. They raised rates, and the currency crashed. That is the definition of a confidence crisis. We are entering 2026 with the world's third largest economy navigating uncharted waters. Don't let the calm surface of the stock market fool you. The currents underneath are shifting. As always, cash is a position, and knowledge is your best hedge. If you found this breakdown valuable, smash the like button so the algorithm knows you care about more than just cat videos. Subscribe if you want to stay ahead of the next financial earthquake. I'm Boss, and I'll see you in the next one.